Hi Digital Chiefs, welcome back. Today I've got a question from yet another Sydney startup founder. The thing I'm struggling with is specific advice available for our startup. I don't know if angels are better than VCs, or should we look at incubators/accelerators, Sydney or SF? Warm approaches worth the extra time it takes to arrange? We are just sending our deck everywhere in the hope we learn through trial and error. So firstly, Jason, thanks for your question. I have actually answered the first part of your question about comparing the differences between angel investors, VCs, as well as incubators and accelerators. There's a link to that video here. So I'm going to really address the part of the question that I haven't actually answered. Are warm introductions worth the effort? Hopefully today I'll be able to break down all the things you can consider before you actually spend the time looking for warm introductions. Those of you who've already done a startup fundraising course, you will probably already know the answer to this question. If you are looking to access my startup fundraising course, you can find that at digitalchief.co. It's a 3-hour course that really takes you through how to find investors through cold emailing. So generally speaking, most humans prefer an introduction than a cold email. Not just with investors, you do actually want to have a warm introduction wherever possible. And look, coming from my own personal background, I certainly did not start off with a lot of connections to investors. Most of you are going to be in that situation. And so it's perfectly okay not to have warm introductions, but if you do happen to have them, that's obviously fantastic. However, I will caveat that with certain other things you need to also consider. In Asia, traditionally, it is more related to having a personal connection. Having someone know someone was some way of ensuring some sort of responsibility for the capital. However, in saying that, a lot of the Asian cities now, like Singapore, like Hong Kong, like KL, where the speed of business, if everything relied on warm introductions, it would take a really long time. Therefore, a lot of these markets are actually really evolving to be a lot more open to cold email. Does it actually warrant the time though to spend getting the warm introduction, right? You need to spend time asking permission from this person, getting them to actually do the actual introduction itself, and then really waiting for them to follow up. This is a lot of time spent and somebody having control of that process. As much as possible, being a really driven entrepreneur, you want to maintain as much control over the process and the speed of how all that happens whenever you can. So before you really spend time investing in this process, you do need to answer perhaps a few questions related to this particular person making the warm introduction. You should have some sort of understanding of the relationship between this warm introduction, the connector in the middle, to the actual investor. The questions include, how do they know each other? And then how well do they know each other? And then thirdly, do they trust each other? Some of these questions you're probably not really going to know. The connector itself probably doesn't really know the answer to these. The idea is that you have some understanding of their relationship and whether they've done business together, whether there is already some sort of established track record between these introductions. Have they co-invested perhaps? Have they done any business transactions together, successfully or unsuccessfully? How responsive will this person be to this introduction? Will this connector of yours be actually able to get a response from this investor? How long will it take? And so if your connector can answer a couple of these questions, it probably means they have a relatively good relationship. It does require that this connector has some understanding of what kind of investments this investor does typically, i.e. the check sizes. How much money does this investor typically invest? If they've done business together, they will know roughly the appetite, sizes of the deals that can be done with this particular person. So understanding their check sizes, understanding the sector, the expertise of this actual investor is really important as well. You obviously don't want to be pitching a med tech startup, a medical device startup, when this person has mainly a banking and finance background. Again, this connector understanding some of the interest areas, the expertise is really quite important prior to making these introductions. Generally speaking, there is a priority list in terms of the kind of people that would make the best warm introductions. If you've taken my course, you've already seen this list. Some investors will disagree with this particular list, but just get a general sense of the order itself. As much as possible, if you've got existing investors or incoming investors, they're the best people to really connect with another investor, that they've already got some skin in the game, they can vouch for you, they've already put some money down as well. Other investors that probably aren't really investing because it's not the quantum of money that makes sense for them, i.e. you might be raising 10 million, but this investor only writes checks of 50K and it doesn't really make sense to have them on board, or this particular investor is not the right sector, but they're happy to make a connection with an investor that's actually in your sector. For me, I will tend to prioritize an introduction from an investor, a fellow investor, i.e. someone who understands the roles and the risk of being an investor, someone who's been in my shoes, over someone who's actually not investing any of their own personal capital. Even if they've lost money, a little bit more credible than someone who's never invested any of their capital. Third on the list, in my opinion, is really portfolio founders. So approaching the companies this particular investor has already invested in is a great approach. They will usually already be really friendly with this particular founder if they've invested in them. Again, a couple of caveats around that. Founders are not investors though. They've obviously successfully been able to attain investment from this particular individual or this particular fund, and so will probably be able to give you great advice and might be willing to do an introduction for you. However, a lot of the time, founders who sent me introductions, they're not really understanding what I'm needing as an investor. I will tend to always still prioritize introductions from other investors. If you don't have those connections, portfolio founders are great. Typically, you want to aim for founders that's already exited, given a return to this particular investor. They're the best founders to go after if you need introductions. Failing that, a founder that's this particular investor's funded in the last 2 years. Not really more than that. The reason for that is because you might not understand whether or not this founder-investor relationship is still a good one. It takes 24 months for new fundraising rounds to be raised. 2 years is sort of the maximum limit, where if things have not gone well, they've not raised another round, then the relationship might not be as good as it was. And then fourth on this list is really colleagues, ideally more business connections rather than personal connections. They will just understand how this investor operates a little bit better. They'll probably be in the same sector if they're a colleague. And then last really on that list is friends, family. Not saying that the personal connections are not valuable. It's just a little bit hard to tell whether or not the personal connection understands. I have many close friends and family. They are not even close to in the same sector as I am in for work. I would trust them with my life, but in terms of investments and business, it's a completely separate game. So I think as much as possible, you want to really approach those who actually have an understanding of the business side of this particular investor. End of the day, I'm speaking about individuals you're pitching to. Even if it's a fund, it is an investor in that fund, a partner, a managing partner, an analyst of some sort that you're speaking to. Personal connections, if you really don't have anything, but again, go back to a couple of those questions I asked in the beginning. How well do they know them? How responsive are? What have they done together? If they don't really have quick open answers for this, they might not actually have a great relationship already, and that can actually do more harm than good. If you've done your research on this investor, hopefully, again, if you've taken my course, you know how to do research on an investor. A well-written cold email pitch will do just as well as some of these introductions, because you've been able to show that you understand this particular investor. You've been able to really stand out above the crowd from a lot of their cold emailing. The amount of time it takes to perhaps go to that warm introduction, if they don't have already a good, strong, trusting relationship, if they don't really understand this investor, then you might be actually better off spending that time researching and then writing a really good cold email pitch that's personalized, rather than handing over that introduction to someone else in the middle who might not have a great relationship, might not have a trusting relationship, and then have your particular business tied to the strength of that relationship. So if you happen to have a great warm introduction to investors, that's fantastic. You want to go ahead and actually write the introduction email, ideally at least the middle part of it, about your business, and let this warm introduction tailor it. Make sure that you follow up for the introduction. Investors get pitched a lot of the time, and so emails do get lost, and sometimes it does require that follow up a few days later or a week later to make sure they've actually received that email. Another challenge with warm introduction is that you are relying on somebody else to do that favor for you. One thing I really like about cold emailing is that you control the narrative, you control the feedback. If you've sent something and it doesn't come back, at least you know it didn't work. If you sent something and they said no as well, you get that direct feedback, and you can actually help improve that process. The way you've written something, maybe you've forgotten to spell check. There's some basic things you can actually learn from cold emailing yourself. If you don't have really good warm introductions, or this person takes forever to actually make the connection for you, one tip that I really like doing myself, where you control the narrative, i.e. you're cold emailing that particular investor, but you've got some information from the warm introduction so that you can tailor the cold email to this particular investor and directly follow up yourself. But in that initial cold email, actually drop the name of the person who is the connector, how they know each other, why this particular connector recommended you talk to this investor, and why you're cold emailing them. As much as possible, you want to mention and tailor this to the individual you're hoping to pitch for investment. That way you can actually control the narrative, write it the way you want, tailor it the way you want, and then proactively follow up as well, managing that timeline, managing that process. I find this is a great middle ground when you're not quite sure that the warm introduction is going to be reliable, i.e. whether they have a strong connection or whether they're actually going to make the introduction in the timeline that you need. This is a bit of a win-win, particularly if you've actually spent time building your online profile. If you're wanting to know a little bit more about how to make sure your LinkedIn profile grabs the investor's attention, give me a comment below. You still need to spend time understanding the investor, even if you've got a warm introduction. You're making sure you are hitting the key points that this particular investor and their fund is looking for. If you're an investor, I'd love to hear from you. Do you always prefer warm introductions? Would you rank getting introductions from other investors ahead of founders and ahead of personal connections? What's your personal ranking criteria? I'm sure many of the entrepreneurs would love to hear how you would like to be approached if you are being cold emailed and being pitched for investment. What are your key hitting spots? What are some entrepreneurs actually lacking when they cold email you or when they get a warm introduction? So one of my pet peeves is really making sure that the warm introduction itself actually has gotten permission from me to actually make the connection on the odd occasion, and actually very rarely do I get them from other fellow investors. Other fellow investors understand this etiquette that you always get permission before you make the founder connection to the investor. If they're really good at what they do, they will get a lot of recommendations and a lot of introductions. Getting permission is quite important for them to make sure they will actually respond to you when the connection is made. How have you guys gone in emailing investors? Have you had a lot of success with warm introductions? Do they always work well? Do they not work so well? Would love to get your feedback. Take care. Until next time. Bye, Digital Chiefs.